We're partway through our corporate earnings season, and it's ugly out there, with the economic downturn proving more difficult than many executives expected. How are they handling it?
We are finally starting to see some, meaningful and, serious cost cutting. Is it too late? Yeah, but we didn't know it was going to be this bad.
We've seen from companies including Spark the defending of a dividend. Investors are calling BS on that.
I think you're right. There are some boards who should probably react faster to that, and it's not 100% clear to me why they keep it going.
Is it structural, cyclical, or straight catastrophic? The top New Zealand listed companies have started the year sinking. Property is soft, with Ayrburn owner Winton Land's boss Chris Meehan saying this economic downturn has been more severe than expected. Fletcher Building's loss deepened to $134 million in the 6 months to December. And steel demand is at its lowest level since the 1990s. Any company that relies on consumer spending is struggling. Sky City, retailers, and Sky TV. Cuts to government spending have hurt even the most defensive data-driven companies. Spark is one of many cutting its own costs as a survival tactic, but rising unemployment may only prolong the economic pain. We're about to assess the damage with Forsyth Barr, an investment firm that has strong ties with all our listed entities. This week, its investment bank arm helped Ryman Healthcare raise another $1 billion, something that impacted its share price. Their team is tight-lipped on Ryman, but Equities analyst Aaron Ibbotson has much more to say about Spark. He downgraded the stock before the sell-off, but even he's been surprised by just how much it's suffering. Well, Aaron, thank you for doing this. Good to see you.
Good to see you, Madison.
I don't want to put words in anyone's mouth. So if you can describe and sum up the earnings season, granted we're only part way through it, it's not completely over yet. Throw some adjectives around that are in your mind.
Well, so we're sort of halfway through, but I think a few trends are pretty clear. So the last 6 months, now this was largely predicted by us in the market, has been again very tough. So difficult, I guess, is an adjective. But a few bright spots thrown in there, here and there. I think a more serious approach to cost cutting from quite a few of our larger corporates starting to come through, but primarily maybe when you look forward. I think maybe the consumer remains weak. Government spending has been called out as an area of weakness specifically. So I guess it's been yet another tough earnings season for New Zealand, or at least it looks like that so far. Not dramatically worse than expected, but probably in line with pretty low expectations, I think it's fair to say.
Not only the results, but also the commentary has been pretty negative. We heard from Winton, the property company, their CEO, saying that this has been a more severe and more prolonged economic downturn than they expected, and I'm sure many others would agree with that. Is this all recessionary, or is there also a bit of New Zealand management malpractice involved?
That would be a too strong word for my taste. I think New Zealand management has sort of ended up in a relatively unfortunate situation where, first of all, this downturn has been, very long. We sort of bounced around at the bottom for well over a year now, and maybe 2 years, some would say. So they've been excused, I think, for sort of, the turn is around the corner, we need to prepare for the next 3 months. And on top of that, normally when you see a downturn, you quite quickly see significant cost cutting. But when the downturn started to happen, call it maybe 18, 24 months ago, we were still in the midst of a sort of quasi post-COVID inflationary period. Labor market was tight, so it was very hard to embark on any cost-cutting measures at that time. And then sort of a lot of those trends came together, I think, over the last 6 to 12 months. So that's why it's been difficult. But for sure, a few management has probably been too slow to react to the weakness in the end market.
On the downturn specifically impacting our large companies' revenue, who would your example be of who's been hit the hardest, and to what degree?
Yeah, well, if you take the building materials and steel companies, so like a Fletcher Building or Vulcan Steel and Steel and Tube, clearly, you would expect that. They've been very hard hit, and you mentioned Winton, but I think Steel and Tube said that they had the lowest demand since the 90s. I think Vulcan said this is significantly worse than the global financial crisis in 2009. And I think Vulcan even had lower than they had during COVID lockdown when they looked at the end demand. So clearly, if you look at, say, steel demand or one of those core, cyclical demand drivers, it's been very, very weak. But also if you look at, say Spark, they've seen weakness across a lot of their, in particular, IT services or enterprise businesses, so exposed to government and large enterprises. They've seen fleet reductions impacting. They've, seen much tighter spending by the government, which has impacted several of their business lines. So, that's probably where you've seen it the most. And New Zealand is full of quite defensive companies, so there's a lot of companies who just sails through this.
Well, I was going to say that Spark and even that damage has spilled into the likes of Chorus. I mean, these are supposed to be the defensive necessity names that shouldn't be impacted to this degree. So what's different about this downturn that perhaps no one really factored in? And how has that hurt them more than most, including the management of those companies, probably would have expected?
Yeah, I'm going to do a boring analyst answer to that one. I think there's a lot of different factors, and as often with New Zealand, it's quite company specific. So I would say, Chorus had a very minor miss in my view. It's a very defensive company. But I think one of the things you're seeing in multiple results is what we call trade downs. And it was modestly showed in Chorus results, where, their home fiber starter product, which is their entry level, was maybe a bit too popular. And you saw a couple of people shift down from more expensive plans. In Spark, you've probably seen it through market share losses, both on the IT side and on the broadband in particular, and to some degree corporate mobile side, where people have moved either to, say, 2 Degrees, who's a little bit cheaper, or to other providers. And again, if you take Sky TV, it was a messy result. I think that was expected largely. But you see a switch from, the Sky Box, sort of the more expensive satellite product, to, quite good performance from their Sky Sports app, for instance. So you sort of see that trade down. And I think people expected it maybe a year ago or so, when the consumer were sort of known to be very weak and interest rates were high. Now interest rates are coming down, and we're sort of waiting for, when is the recovery coming? But it's quite delayed. If you look at the balance sheet or the P&L of the consumer, it's still looking very tough. Mortgage rates are coming down, at the front end, i.e. what the new mortgage is, quite a lot. But if you look at what people are actually paying, it's barely moving. And even Sky City, they had lower spend per customer and things like that. So these are small signs that's popping up everywhere that consumer is holding back a little bit.
I am going to ask you, but I'm going to save it till the end, on your time frame, if you could give us a forecast as to when the recovery may happen, hopefully sooner rather than later. But just on the consumer demand weakness, is there perhaps anything out there in any of these signs signal to you that this is actually a structural change in the way consumers spend, behave, and the way it impacts these large companies that we've spoken about?
That's a tough one. So in the short term, you tend to not pick up structural trends, and they show up in the longer term. But if you say retail, for instance, in New Zealand, so clearly there's a slow trend towards, a larger proportion of the consumer wallet going to the likes of, say, an Amazon or a Costco, or maybe even IKEA when they arrive. So you have this slow trend out of the core New Zealand companies. Within the corporate world, and particularly if you say IT spending, you see the same thing, and maybe those trends are happening a little bit faster. You know, a larger proportion of the IT budget, say, is allocated to Microsoft or Amazon, you know, web services or something like that. And that, you don't really think about it, but then suddenly you start to see it in, say, Spark's IT business or in other parts of corporate spending.
I hate to suggest that this is something worse than it is, but if I could summarize that then, is this like watching what was a slow expected death of New Zealand's defensive names that's all of a sudden become a rapid death from these big tech names and them existing and growing their presence in our market?
Well, I would actually disagree with that, because if you look at New Zealand's defensive names, you know, we've singled out Spark, and you know, they had a quite noteworthy, relatively bad result, obviously, this reporting season. But if you look at the defensive sector overall, the largest proportion for sure is this electricity gentailers. And there the trend is actually going in the opposite direction, you know. So we have these large-scale, you know, data center providers. So again, you know, Microsoft and Amazon and Google. They're actually, to some degree, coming to New Zealand, opening their data centers, and they want the power from our electricity companies. That's actually beneficial. If you look at our REITs, so real estate companies, that's another large proportion of the defensive index. Again, you know, this is not necessarily anything that impacts them negatively. You know, there was a lot of talk about how we were all going to work from home 2 or 3 years ago. That's out the door now.
We're doing this in your office.
Yeah,
in person,
well, there you go.
Good.
We're back in the office. So I would say, you know, there are pockets. And I also think, you know, what we're experiencing from, you know, international companies coming here, our company is also doing overseas. You know, if you take the big success of this earnings season, A2 Milk, you know, they've had a fantastic, you know, result compared to recent history, and it's clear that they, you know, they've sorted out what's been, you know, some pretty dramatic changes of their business model over the last 2 to 3 years, and they're now, you know, properly starting to take market share in China. If you look at EBOS, you know, they're doing very well in Australia, likewise Freightways. So it's sort of, you know, these trends are showing up in different places, so I wouldn't call that, you know, a net necessarily negative for NZ Inc. And at the end of the day, I think it's good if we get, you know, the more New Zealand companies can adopt these, you know, best-in-class technologies, the better it is. So I think it's actually a good thing for NZ Inc. that some, you know, type of IT, etc., that we used to have here and we're satisfied with is now being competed out by more efficient and better ways of doing things.
I always like your optimism, Aaron. Should this then be a turning point for New Zealand corporates to up their international ambitions?
For some, yeah. I think, again, you know, like we have a lot of very domestically focused companies, and I wouldn't want, say, Mercury or Meridian building power stations overseas. But I do think, you know, we've got a few smaller tech names that we rarely talk about, but we have some, you know, great tech companies here in New Zealand who do have quite significant overseas ambitions, and certainly I am very keen to keep them here and support them. You know, you have Gentrack and Vista, and you know, there are several of them who is doing quite well overseas, primarily have an overseas market. But we have also sort of, at least from a New Zealand capital markets perspective, lost a few very successful New Zealand companies. You know, we're not sitting here and talking about Xero, who is a huge success. We're not talking about Rocket Lab, who is a huge success. But you know, we don't talk about them because they're not listed. But these, you know, in some way at least, are New Zealand companies that are having huge success overseas.
And we're very proud of them.
Correct.
On Gentrack, they had an incredible share price run last year.
Yeah, I think, you know, again, you know, this is, they're basically moving to software as a service, I guess it's fair to say. And they've had, you know, some great success winning some business in overseas, in the UK primarily. And similar to Vista, you know, they've gone through what is this quite painful change when you move from a license model to a software as a service, which is one of these many buzzwords these days. And the share market, in my way, or in our view, correctly appreciated it. So.
One trend that I've noticed that I wanted to discuss with you in regards to share price action and the way investors see that now. We've seen from companies including Spark the defending of a dividend and the commitment to continually pay it out regardless of how much said company is struggling. Investors are calling BS on that. I mean, if you look at the way they've reacted to Spark's share price, it's been horrific, really. Why do you think there's, in my view, a clear disconnect between what boards think investors want and what investors are telling them they want through their share price?
Yeah, well, investors are a fickle group. I think there's a bit
Careful, they're my favourite people, Aaron.
Yeah, my favourite people as well. But I think there's a bit of a history there. So I think historically, and for sure, if you look at the New Zealand corporates overall, we pay New Zealand corporates pay much higher proportion of their earnings into dividends. And if you don't have any good reinvestment opportunities, that's what you should be doing. So I think particularly within the defensive names in New Zealand, there's been this culture of defending the dividend above all else. But I think what you're seeing is when that gets disconnected from the cash generation in the business, then that doesn't work anymore. And some boards have maybe been slow to react to that. I would agree with that. Clearly, many investors prefer a stable dividend, and having a dividend that never goes down is a huge asset for a company in capital markets. But they also need to be able to show that it's sustainable. And when you start to see the fundamentals of the company deteriorate or change nature, being more cash consuming, you have to address the dividend. And I think you're right. There are some boards who should probably react faster to that, and it's not 100% clear to me why they keep it going.
One thing that is being addressed, and you alluded to this at the beginning of this chat, was cost cutting. What do you make of the broader survival plans being put in place by these companies? Is the cost cutting too much too late, or is that perhaps because we're paying the price of them doing it later than they should have in many cases?
Yeah, even though it's obviously painful sometimes for people who work for these companies, I think it's sort of from a capital markets perspective, it's one of the positives I take away from this earnings season, that we are finally starting to see some meaningful and serious cost cutting, which is right sizing, which is the buzzword. But where you're seeing you've lost demand, you need to cut costs. And what that does from a capital markets perspective is when we do see a pickup, you can see quite a lot of leverage in earnings, because these companies, our expectation at least, is will be pretty slow to put costs back into the business. I think it's a good thing. Is it too late? Yeah, but we didn't know it was going to be this bad end demand situation. They probably should have started earlier, several of them. But I think, take Fletcher Building as an example, which hasn't had a very glorious ride on the New Zealand market over the last few decades. But for the first time, and I think in at least 2 years, probably more, we've actually edged our numbers up a little bit this earnings season. And that is not end demand surprising on the upside. That is them actually delivering on the cost cutting. Nothing dramatic, but these are sort of the seeds of a positive recovery that has the potential to come towards the rest of the year.
None of this gets me excited about growth, though. It is pure survival for a lot of these names, including Fletcher Building at the moment. Do you see any growth across the market, and where?
Yeah, I mean, there's, the domestically focused companies don't have a whole heap of growth, I think it's fair to say, at the moment in New Zealand. There are a few small ones, we call them sort of market share gainers. So, if you say like a Hellenstein or a Turner's, they're executing extremely well, they're growing. We talked about the tech names, Gentrack being one of them, Tower. These, not a tech name, but smaller company.
I don't know, it's definitely leaning into tech, for sure.
So, there are growth companies in smaller ones in New Zealand, but if you take our big sort of growth companies, Fisher & Paykel, EBOS, Mainfreight, these companies have 2 decades of pretty phenomenal execution of growth, and they continue. Mainfreight is experiencing a sort of cyclical downturn across its international and domestic operations. But if you say Fisher & Paykel and EBOS, they continue to grow very well, and these are some of the largest cap names. But if you look at our domestic defensive market now, growth is not what sort of jumps out at you.
I said I was going to save it till the end to ask you for your forecast as to when we might expect a recovery. And let's focus on those domestically defensive. If you could pick a year and maybe a month, a day, if you've got it, as to when this may all look a bit brighter?
It's always coming the next 6 months, Madison.
And then the next 6 months after that, and then we'll rehash.
Well, to be fair, yes, but we will have a recovery. Economies are cyclical. If you look at the backdrop now, it doesn't look fantastic, but it absolutely doesn't look bad. Interest rates are coming down, tourism is coming back, the global economy is doing okay. If you look at the major cuts, say from governments, probably behind us. House prices are stabilizing, which is sort of an important sentiment. So, do we think we're going to see a fantastic, economic recovery over the next 6 months? Absolutely not. But, all indicators are that we should have a significantly better 25 than 24. And that can, some companies will be able to take advantage of that more, and some less. But as I mentioned, with the cost cutting, a lot of corporates have now set itself up, even Spark, to be able to, sort of muddle through a very weak economy. So I would say I'm slightly more optimistic than I would have been a few months ago, but it's still tough out there.
Our glass half full guy. Thank you so much, Aaron. This was fascinating. Really appreciate your time.
Thank you, Madison.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.